Management of Insurance Services. Today we will cover Unit 9, and this is also another type of specialized insurance, which is property insurance. In the last few units, we have also covered few other specialized insurance, like the insurance and the vehicle insurance. So today our focus will be on the property insurance. This module will concentrate on the insurance and the property insurance. We will understand the basic principles of insurance as it is applicable to fire insurance, the different product ranges and the covers of different products, and the process how the fire insurance and business operates. So this will be our focus of this session today. Now, when we talk about property insurance, it is mostly confused with the fire insurance. So the people or individual, they think that when we talk about property insurance, it is insuring our own property with because of due to some calamities which is caused by the fire. So, but it is actually the fire when we are insuring any property from fire, the fire is just, you can say, a subset of the entire property insurance. You can have a fire insurance separately, and you can have property insurance, which is a broader concept of the fire insurance for your to safeguard your property or insure your property. So fire is reported in newspapers and television, especially in the urban areas. So fire incidents causes loss of human lives. It damages the property and assets of an individual. It may be in terms of buildings or machineries or equipments and goods, etc. And such losses can be very large, and it may permanently affect one's business, or it can disrupt the operations under normalcy until a particular fair normal situation is restored. So for a temporary point of time, if suppose there is a damage for fire for a few days, maybe the operations can be ceased unless and until we get into a normalcy condition. So fire can cause a huge damage. So without a fire insurance, the owners must bear losses themselves. There is the business capitals gets eroded, and banks may face the bad debts. That means when suppose entire setup, a business setup, a farm or a manufacturing unit that has been set up by an individual, and the individual might have borrowed loans from bank to set up the manufacturing sector, and suppose the manufacturing unit sets in fire. So obviously the bank has paid loan to the individual to set up the farm. So in that case, the bank also will be facing the bad debts, because that person whose manufacturing unit is set in fire, that person will not be able to repay the money to the bank. So it is the loss on the part of the owner also, it is the loss on the part of the bank also. So due to daily business pressures, fire risks are often ignored. So when the company personals, they are heavily loaded with different type of works, competition, catering to different customers. So in that case, they basically have a tendency to ignore this type of fire risk. Like in every organization, there are different types of electrical equipments which are present. So that has to be maintained properly, and that has to be insured. The entire building has to be insured so that the risk of fire can be ignored. The risk of fire can be safeguarded in for future. It is not ignored, but it is safeguarded for any sort of future emergency situations. So insurance is usually sold, not bought, as customer need awareness and guidance. So in case of a fire insurance, or in case of a property insurance, life insurance, yes, most of the people nowadays, they know about life insurance, or they know about the health insurance, or they know about the medical insurance, because that is their day to day requirements. But when it is a fire insurance or it's a property insurance, so in that case the people neglect this aspect because they are not more aware about such type of insurance schemes. So in this case, in case of a fire insurance or a property insurance, the insurance is usually sold, or it is directly, it is the person from the insurance company, they have to go and approach to the person, to the business owners, that such type of insurance exists and they should opt for such type of insurance schemes. Now, as I was just discussing, that property insurance and fire insurance are usually confused terms. So, property insurance is something which is a broader concept, and fire insurance is just a subset of the property insurance. So, fire insurance is a part of the property insurance. So, when we talk about the property insurance, that will include the fire insurance, and that will also include the engineering insurance. That means, in suppose it is in a manufacturing farm, there are several machineries which are there used for production. There are other utility items which are used during the production, as well as there is also a fear that fire may be set anytime in the manufacturing unit. So when it is a property insurance, you are insuring all your machineries against any sort of mishappenings in future, as well as you are also insuring the entire building from fire. So that is property insurance, which includes the fire insurance. But when we talk about fire insurance on only, then it is exclusively safeguarding the property against catching of the fire in future. So, what is the difference between this fire insurance and property insurance? Here, in case of a fire insurance, the coverage, financial coverage, the fire insurance covers a limited risk. That means, suppose a property worth of, let us assume, 5 lakhs has been set fire, that has been damaged or destroyed by fire, then that means it will only cover that much amount. Like there is a particular limit to which the insurance company will cover. But when it is a property insurance, as I said, it will cover it has more coverage, so it will cover the entire thing which is available in that particular building. So it is not only with fire, but also the other aspects of the machineries, or there are other utility products which are items, or there may be storing the different finished goods or raw materials there in the building. So all those things are also covered in the property insurance. So here, in case of fire insurance, the coverage is limited. In case of a property insurance, the coverage is more wider or broader in comparison to the fire insurance. In India, the fire insurance scope can be expanded through industrial all risk package policy. As coverage becomes wider through the package policies, the difference between fire insurance and property insurance becomes less clear. So that is why there is always a confusion when we talk about a property insurance. People think that it is safeguarding the entire property against the damage of fire. But in case of the industrial all risk package policies, here there is a wider coverage which includes the fire insurance, as well as it also includes the property insurance. So some of the distinctive features of fire insurance is useful for homes and households, for industrial units, for shops, offices and factories, and for other non-commercial places like schools, college and hospitals. So this will cover the entire gamuts of units which are prone to damage by any sort of occurrences of fire suddenly at any point of time. So through fire insurance, it is a part of property insurance, and its scope is also quite wide. So it covers the fire and special perils. It covers natural risks like storm, flood and inundation. It also covers man-made risks like riots, strike, malicious, and terrorism damage. So when we talk about a property insurance, it covers all these aspects. Fires and special perils, it will cover the natural calamity destructions, it will also cover the man-made destructions. Uh, it is with respect to the property insurance. But when we talk about only fire insurance, then it will only cover the damage caused due to fire. So consequential losses are losses of profit due to business closure after fire. So it covers only along with the fire policy, and it is not a separate, not sold as a separate policy. So the entire thing is covered in that fire policy only. So customized fire insurance is available for high risk industries like petrochemicals, nuclear power, etc. Premium depends on risk assessment by the insurer. So suppose let us assume it is a educational institute. There also you require insurance of the property, because there also there are chances that the property might be damaged with fire. There are ACs which are installed, there are computers which are installed, there is a generator which is installed inside the building, inside the building campus. So that also has a possibility that sometimes some issues might happen in future, which might cause danger for the catching of fire in the building. So in that case also they are prone to damage by fire. So in the educational institute should has to also go for a fire safety certificate. But there the chances of catching fire is less, but it is mandatory that you need to have a fire safety certificate and all the fire equipments available, fire extinguishing equipments available. Some industries are there which are highly prone to catching of fire, like petrochemicals, nuclear power industries. So in this case where the risk is more which are more prone to fire, then in this case the premium of those companies are higher than with the companies which are less prone to the fire. So fire insurance works on the law of large numbers. When the many small policies are there, so claims are manageable, but a few large industry policies are there where there are claims are also very high. So in case of high claims, their insurance premiums are also very high in that type of industries. Now let us understand the basic principles of the fire insurance. Basically, we are now applying the principles on the fire insurance. These principles, if you remember, we have already discussed in the introductory portion in the block 1, where we had uh, learned about the entire insurance schemes as a whole. So there we have understood about the different principles of insurance. It is irrespective of a life insurance or irrespective of a non-life insurance product. So now we will understand the different principles of insurance products, but here we will focus more on the fire insurance products. So when it is the first principle is principle of utmost good faith. Now, this here, the players of this insurance product in this scheme, there is a insured the person, the company who is taking insurance from an insurance company, or the individual who is the customer, who is the insured, and the insurer who is providing them insurance against any sort of emergency situations in future. So it is the insurance company. So fire insurance works on complete honesty, and honesty has to be between the insured person, who is the customer, and the insurer, which is the insurance company. The insured must truthfully disclose all material information to the insurer. So, suppose I am the owner of a company and I produce garments in my unit. So I have to disclose each and every materials which are there stored in that particular unit. What are the different types of machineries which I have? What are the different types of electrical equipments which I have in that unit? And what sort of, whether I have taken any sort of maintenance schemes or not, everything I need to disclose regarding the entire unit to the insurer, that means the company, so that the company can assess how much risk I am liable to in future for all these types of materials which I have in my unit. And accordingly, by assessing the risk only, they'll be able to fix a premium amount. So the I should truthfully disclose all the types of material information, materialistic, what all things are there available in that unit. So the insurer relies on to this information to assess the risk. That means if suppose that there are chemicals available in my unit, so obviously risk is higher. But suppose I tell that garments are available, or suppose some raw materials, nuts and bolts are available, then the risk is a bit less. So this, by assessing a risk, they'll be able to fix up a correct premium amount. And then finally the claim amount also can be decided. That means what should be the amount which the individual can claim in case of certain unforeseen situation in future. So the insured must disclose the nature of business, what business, like I just told that I'm into a business of garment. So nature of business should be shared. What type of goods are stored, whether it is garments, whether it is rubber, whether it is wires, whether it is copper, any what sort of goods are stored in that unit, and what is the total value of the materials which are there, what is the total amount or quantity as well as the value, the price of the assets which are there in the entire building, and any material change after the policy issues. Now, policy, suppose the policy is issued, you have done the fire insurance, then after that suppose you have added some more materials to your building, that also any sort of changes in the material, any different materials you have used, that also it needs to be intimated to the insurer or the insurance company. So there has to be a truthful disclosure, which is based on the principle of utmost good faith. The factory owner declares, let us assume that he has a cotton goods, his worth asset value is 50 lakhs, and there is no hazardous materials is stored. So this is what is his truthful behavior. Now, if a fire occurs, the insurer will settle the claim fairly because all the information has been given correctly to the insurer. And sometimes there is non-disclosure or wrong behavior, like a warehouse owner stores some chemicals, but he tells to the insurer that he has some general goods, normal goods, which are not hazardous. So that is a misinterpretation of the by the insurance company. So in that case, they can also reject the claim or cancel the policy, because whenever they're settling the claim, they are going to survey the entire thing. So that is there is a process which they will conduct while settling the claim. So if there is a misinterpretation of the different of the information which has been provided, then obviously it can call for rejection or cancellation of the policy. So duty of the insured after taking the policy is the insured must safeguard the property at all time. It is not that you have taken a policy, insurance policy, so you will be negligence and you will have a casual approach. It will you should always, the insured or the customer should always safeguard the property, take steps to reduce or prevent losses. That means suppose you don't have a maintenance policy of the entire machineries, or you don't have the maintenance policy of the generator or the aquaguard or anything which is available in your premises. So then that may cause some uncertain issues relating to fire in future. So everyone, the insured also must take steps to reduce or prevent the loss and have to avoid the negligence. Keeping inflammable goods close to a heat source violates a good faith. That means it is sheer negligence of the customer. This is just an example. That means in the habits and the conduct also, the customer or the insured person has to be very careful so that such type of event does not occur in future. Survey and responsibility. If this insurer conducts a survey, the insured still remains responsible for correct disclosure. Survey does not remove the insured's duty. Consequence of violating utmost good faith, insurer has the right to void or cancel the contract, and the claim also may be rejected. So during the survey of claim settlement, in that time also the insured person should remain trustworthy, and he should disclose all the facts that was there within the materialistic fact that was there within the unit which had caught fire. In case there is violation of the principle of good faith, then the insurer will cancel the policy or the claim might be rejected. Now let us move on to the next principle, which is principle of insurable interest. Principle of good faith is that both the insured and the insurer has to have a mutual trust, and insurer insured the insured person, the customer, has to reveal all the facts and figures to the insurance company. Here in this principle of insurable interest, here when you are going for fire insurance of your property, it has to be in the name of the person who is actually facing the financial loss. That means the owner or the person who is actually liable for the financial loss. So only a person who has a financial interest in the property can take a fire insurance. The owner of the company can avail a fire insurance. Not an employee cannot avail a fire insurance. So only the person who has a financial interest in the property against which the fire insurance is taken. So in that case, that is the principle of insurable interest. So insurable interest exists when loss of property causes financial loss. Example of people with insurable interest is a owner. As I said, that owner of a factory or a house will be the person with insurable interest, as well as the bank which has given loan on the property. Let us assume a borrower takes a loan from HDFC Bank, and HDFC Bank may ask the borrower to take a fire insurance, because ultimately if the house catches fire, then it is the loss of the house owner definitely, but it is the loss of the bank also, because the bank has kept the house as the security deposit, and bank has given loan to the person for availing the house. So both the bank and the borrower have the insurable interest in this case. So this is the principle of insurable interest. The next principle is the principle of indemnity. This principle we have already discussed earlier also. Principle of indemnity means it is getting compensation from the insurance company at an appropriate limit of their financial losses. Like suppose an individual has incurred a financial loss of around 5 lakhs, then the after receiving the claims settled from the insurance company, he gets his prior position, that financial loss of 5 lakhs back. That means he is again returning back to his previous state. His actual loss is compensated with this principle of indemnity. So the insurer's duty is to compensate the insured for fire losses. So that is the duty of the insurance company, who is the insurer. The insurer has to compensate the loss for the fire, and compensation is limited to the actual loss which he has suffered. So it cannot go beyond the actual loss. Suppose he has suffered a loss of 5 lakhs, So he cannot get a claim settled of rupees 10 lakhs. So the compensation is limited to the actual loss which is suffered by the individual, and the claim amount cannot exceed the amount of loss. That is what I told, that it has to be in that limit of the amount which he has actually lost. So objective of insurance is to restore the insured to the pre-loss financial position. Initially he had a balance of 5 lakhs. Now his 5 lakhs has been lost. So by taking that 5 lakhs again from the insurance company, he is coming back to his pre-loss financial position. So there is no profit should arise from this insurance. Now suppose he is getting a claim settled of rupees 10 lakhs, so he is getting a profit amount. So no profit amount should arise from the insurance to the insured person. So sum insured is fixed based on the asset value using the method such as fixed sum. So you have a asset fixed sum amount, like a damage up to rupees 5 lakhs, up to rupees 10 lakhs will be compensated up to. But the damage, the suppose in the policy it is mentioned that a damage up to rupees 5 lakhs will be compensated. Now suppose the damage is 2,50,000. So then the damage, the person will be getting 2,50,000. The person will not be getting 5 lakhs. Suppose the person has faced a damage of 7 lakhs, but then also it is a fixed sum. The person will be getting a claim, settling a claim of rupees 5 lakhs, not rupees 7 lakhs. So it is a fixed sum amount which is there insured in the policy. The the asset value also can be based on market value. That means market value of the assets which were there in the godown or the unit where it has caught fire, but that asset cost is minus the depreciation. Cost of the asset minus the depreciation of the different years. It can be also used, also fixed by the method of reinstatement value, that is the cost of the new asset, or the agreed value. It is in case of any sort of art or heritage building which is of significance to the society. So these are the few methods, and which will be pre-decided and which will be mentioned in the policy. So under reinstatement value, here in case of the reinstatement value, the premium are usually higher, or in most of the cases the fixed sum or the market value method is actually used. Apart from these three, we have discussed about principle of utmost good faith, we have discussed about principle of insurable interest, and we have discussed about the principle of indemnity. Apart from these three, there are two more corollary of this principle. One is the subrogation, and other one is contribution. Now, subrogation is a principle which is corollary of the principle of indemnity. So, what is this subrogation? When the insurer pays the claim, it gets all right of the insured. So, now insurer is the insurance company. Now, supposing, let us assume that a production unit is there. The production unit has caught fire, and the insurance company had paid 5 lakhs amount or 10 lakhs amount, which as it is fixed in the policy or the value, the insurance company has paid 5 lakh rupees to the individual who is the owner of that building or of the unit. So the insurer or the insurance company pays the claim. So after that, the insurance company gets all the rights of the insured on that particular building. That means in that the insurance company holds the right to sell all those, suppose there are any scrap material in the building. So now the insurance company can sell those scrap materials and get some money out of that. So that will go to the insurance company. So after the payment of the money which was damaged during the goods which were damaged during the fire. So after the payment only, the entire unit is now in the custody of the insurance company. So insurance company can sell the damaged goods, that means the scraps which are available, or the insurance company also can claim compensation from third parties who are responsible for the losses. Suppose there is a third party, suppose the vendor, or suppose a electronic item which is under the AMC. So the insurance company also can claim because the fire is due to the fault of that company, of that any sort of defects in that electrical appliances. So there the insurance company can claim compensation from the third party who is maybe responsible for this damage or the loss. So this helps in reducing the insurer's net claim amount. Without subrogation, the insured may receive both full claim amount and value of the salvage or third party compensation. Now, if the subrogation clause is there in the policy, then in that case, this amount or the value, salvage value or the third party compensation, this thing is applicable for the insurance company. But suppose there is no subrogation, then the insurance insured individual will receive the full claim amount, and also it is he will sell the scraps which are available, or he can also claim third party compensation for whom the loss has happened. So this would result in profits, and this would violate the principle of indemnity. So usually the principle of subrogation is always there, because in principle, in case of an insurance, there should not be any profit which should go to the insured person, because he is already getting the full amount compensated by the insurance company. Another type of corollary principle of indemnity is contribution. So sometimes what happens, for a particular building, more insurance companies are involved for the policy. So in that case, one company will not be liable to pay the entire amount or claim. So there has to be different, it has to be pulled from the different companies in different proportion, in a fixed proportion. So that is known as contribution, so that the pressure of claim settlement is not in liable to one company only. So contribution applies when an insured has more than one policy on the same asset. One building has two policies or three policies from different insurance companies. The total claim amount received from all insurers cannot exceed the actual loss. Like suppose the claim amount is 5 lakhs. So one insurance company pays 2 lakhs, another pays 2 lakhs, and another pays 1 lakh. So it cannot exceed more than 5 lakhs. It will be just divided in different proportion, in a fixed proportion among the different companies, but the amount will not be more than that 5 lakhs. So this proportion is called the rateable proportion. Each insurer pays only its share of loss. Now, so without contribution, the insured could receive more than loss, and this should lead to profit, violating the principle of indemnity. So in principle, one should remember that there will not be any sort of situation in which the insured person, the customer or the individual who is the owner of the building, he will not have any scope of earning profit. So that is why these two principles, the contribution and subrogation, the corollary principles of indemnity, exists. Now the last principle is the principle of proximate cause. Proximate cause means here one has to identify, the insurance company job is to identify that what is the exact cause behind the loss, so that it will be easier for them to fix up the claims. Like there in some policies, if the cause of the different factors which will lead to fire damage will be mentioned. So anything which is excluding that will not be considered for claim settlement. So there must be a direct cause and effect relationship between the event that has caused the loss and the loss itself. So loss must be caused by an event covered under the policy. So in the policy, all the different events due to which this loss might happen will be mentioned. Anything which is beyond that will not be considered and for the claim settlement. So the loss should be due to an event of chance, not an excluded cause. Principle of novus actus intervenens. No new excluded event should intervene and become the real cause of loss. No new. So all the events which are mentioned in the policy only will be considered for claim settlement. No other new causes will intervene for and become the real cause of loss. And if there are any new cause, then that will not be considered for settlement of claim. If a policy excludes war, so fire caused during war will not be covered because the proximate cause is war, here not the fire. If war risk is specifically covered, but in the policy, if war risk is also covered, so then your premium also will be more and loss due to war related fire will be covered also. So all the different types of accurate events will be mentioned. Anything which is not mentioned will not be covered, considered for claim settlement. Now, these are the basic principles of the fire insurance. Now, let us move on to different policies and guidelines. The standard fire and special perils policy covers the fire and related risks. This is the policy which covers the fire and the related risks. The common perils covered include the fire and lightning, explosion and implosion, aircraft damage, riots, strikes, malicious and terrorism damage, storm, tempest, flood, inundation, impact damage by the third party, subsidence, land and rock slide, bushfires, burst or overflow of water tanks, leakage from sprinkler systems, and missile testing operations. These are standard fire and special perils policy covers which is related to the fire and the related risks. So this will be mentioned in the fire insurance policies. But we were just talking about some exclusions which are not there. But if you are including these excluded things as an add-on to the policy, then extra additional premium will be paid by the policyholder. So some losses are excluded unless an additional premium is paid. So 5% on every claim borne by insured. War, it is deductible. War and civil war, this is not included. Nuclear risk, pollution and contamination, bullion, art, books, important records, explosives, stocks in cold storage, electrical machines and apparatus, architects, fees beyond limits, loss of earnings, spoilage from processes, theft during or after peril, earthquake or volcanic risks. It is covered separately. If it is added as add-on, then more premium is there. And damage to properties outside the insured premises. So these are things which are general exclusion which are not covered, but few might be there with a additional premium. General conditions of the policies are policy becomes void if there is non-disclosure or misinterpretation. We were talking about the principle of utmost good faith. So if suppose some thing is not disclosed properly, then there is misrepresentation. So that policy becomes null and void. Losses up to 7 days after building collapse are covered. So losses within the 7 days after the collapse of the buildings will be covered. So it should not be beyond 7 days when you are going to settle your claim or give your claims. Claim must be reported within 15 days, extendable up till 12 months with insurer approval. Claims must be reported within 15 days of the happening of the event. Insurer has the right to inspect the premises. There will be survey made by the insurer. Policy can be terminated with 15 days notice. Fraud leads to forfeiture of policy and premium. If there is a, this is also aligning with the non-disclosure and misrepresentation. If there is fraud by the insured, then it will lead to forfeiture of the policy and premium. Contribution and subrogation conditions apply. We have just discussed about the corollary of the principle of indemnity, which is contribution and subrogation. That will apply because no profit condition or scope of profit should be given to the insured person, because he is already getting his claim settled from the insurance company. Average clause applies in case of underinsurance. Communication must be in writing, and premium and sum insured must match, because when, if suppose you are paying premium more and you are getting less sum insured, then it will be dissatisfaction in case of the individuals who are suffering huge loss. So sum assured and premium should match, because it is of mutual interest to both the insurance company as well as the individuals. Now let us move on to the process of how this settlement takes place of the fire insurance, how the business is operated. So the operational flow, as you can see it here, the operational flow is a proposal. Proposal, that means a policy is prepared or proposal is given by the individual. Then underwriting is agreed upon by the insurance company. Insurance company, after underwriting, it gives a issues a policy, then claims, and then the renewal after the expiry of the policy. So fire insurance follows a proposal, claim, and renewal cycle. This is the broad heading. It follows a proposal, then claim, then a renewal cycle. So proposal is evaluated by the underwriting department. The risk is asset, and terms, condition, and premiums are fixed. So proposal is given by the proposer, who is the insured, the customer. Suppose the customer is just filling up the form and giving the application form to the insurance company with all the details about the assets, his building, what all things he has, what is the age of the building, everything he is giving in detail in that policy, in the form application to the insurance company. So now that proposal is evaluated by the insurance company, and so that they can assess the risk. They will assess the risk, and then they will finalize the terms, conditions, and the premium for that particular proposal. After acceptance, the policy is issued. Fire insurance policies are generally valid for a period of 1 year. If a fire loss occurs, then the claim is handled by the claims department. A surveyor assesses the genuineness and extent of loss. Claim payment is made based on the survey report. And if no claim arises, then the policy continues till expiry, and then it is renewed. So this fire insurance proposal, the sales team, it is a direct marketing concept. So the company insurance person, the sales team, the agents goes to the person who requires a fire insurance, explains the need and importance of fire insurance for their own organization. So now then, after creating an awareness, after convincing the customer fills the proposal forms with complete and correct details. Just that means the proposal form is an application which the customer fills, giving the entire details. It is filled very honestly by declaring all the materials which are available in the property for which he is taking the insurance. So proposal form helps the underwriting department to assess the risk, decide whether they are going ahead with accepting the proposal or not, issue the policy document. After accepting only, they will issue a policy document which mentions the period, the sum assured, the premium amount, everything will be mentioned there, and the different terms and condition, what all things will be included, what all things will be excluded, everything will be mentioned there. So the principles applied, insurable interest, that means the property should be uh, in the name of that owner who is actually having who is actually giving the proposal form for the fire insurance, and the principle of utmost good faith, that means he has to fill in the proposal form honestly and in good faith. Property covers starts only after the proposal is accepted and the premium is paid. The proposal should be accepted and then the premium will be paid by the insured. Key details in the proposal form is proposer name, address, everything will be mentioned, insurable interest, policy period, past claims, coverage, add-ons, what all things will be excluded, what all things will be included. This we have already discussed in the previous slide. Property, type of property, wood stored, fire safety measures, construction details. These are should be disclosed with the principle of utmost good faith. Some insured buildings, machinery, stock, furniture separately. Declaration, false information can make the policy void, and KYC compliances. So everything has to be mentioned in detail in the proposal format. Then comes when the proposal is given, then the underwriting is done by the insurance company. The underwriting involves the detailed examination of the proposal forms. That means whatever the insured has filled in, the proposer has filled in the application form, it has to be properly checked by the insurance company. So the insurer verifies the information, identifies the hazards and perils and risks, and assesses the overall risk exposure. So insurer will verify all the information which is given. Then the insurer will assess whether the products which are there are prone to fire damage or not, or what is the risk which is associated with this what is the risk which is associated with the uh, what is the risk which is associated with the type of materials which are there in the with the type of materials which are there uh, inside the production unit or the building, how many electrical appliances, how many gadgets are there which are prone to such types of risk in future. It assesses the overall risk exposure, operates on the law of large numbers. So larger pool of insured, then your premium becomes less. And premium is calculated as sum assured divided by 1000 into the rate. This is how it is calculated. And insurance principles applied, this indemnity, we have already discussed about indemnity. Should be no profit from the losses which has been incurred by the insured. The principle of subrogation and contribution also applies here, and the principle of proximate cause. That means you need to know what is the actual cause behind the damage. So four key underwriting considerations has to be made, like fire hazard, what is the source of fire, like electrical short circuit or scrap or construction, fire load, amount of combustible materials, whether it is low, medium or high. This will help in order to assess the risk. Fire resistance, ability of the entire building structure, whether how to withstand any sort of fire hazards, and fire preventions equipments, whether it is available in the building or not, extinguishers, storage systems, housekeeping, staff discipline, everything has to be there or not. So after assessing this only, the insurance company will prepare a risk inspection report and submit it. So policy issuance, after that, if the policy is accepted, then the insurance company will provide a policy issuance or in the fire insurance to the proposer. Policy document. A policy document is issued based on the inputs from the underwriting department. It clearly specifies the period of coverage, the premium amount, the policy value, scope of coverage, and the terms and conditions will be mentioned in the policy. Everything will be mentioned. It reiterates the four principles of the insurance, which we have already discussed, and two corollaries, that is subrogation and contribution. This will also explain the procedure when you are making a claim. Suppose there are certain uncertain exigencies. If you are making a claim, then in that case you are also, the procedure of claim settlement is also mentioned there. Two-step practice is followed. First, an acceptance cum receipt or a cover note is issued, and then a detailed policy document is prepared and it is dispatched. Nowadays, everything is in electronic format, so hard copies are not given nowadays. It is sent to a mail ID, or it is also app-based documents are there. So key contents of the policy or cover notes will be the policy number, the period, property and perils covered, sum insured and premium paid, and proposers and the property details will be mentioned in the policy. The policy schedules will include identification details, risk descriptions, endorsements of any changes, and occupancy-wise net rate data and the applicable discounts. Suppose there are any sort of discounts like claims experienced discount, or suppose fire extinguisher appliances discount. Sometimes the insurance company also gives certain discounts. Suppose the past records of the customer is good, while that means he has not have any sort of claims settled in past. So in that case, he might get a discount that is known as claims experience discount. From his past records and experience, he is getting a discount. He might not have filed any sort of claims. Suppose in the entire campus there are fire extinguishing appliances, periodic disciplinary measures are taken in order to safeguard themselves from fires. So in that case also, that is known as FEA, fire extinguishing appliances discount. So in that case also, the insurance companies will give certain discounts in the premium of that policy. Then suppose there is fire exigencies in that building which is being insured, then the process of claims come. Claim are first intimated by the insured and recorded by the insurer. First it is intimated. Then after it is intimated, then there is the insurer appoints a surveyor. That means a person who goes and visits and sees whether all the details which are given are true or not. So they verify the policy validity and condition, assesses the cause and extent of the losses, and recommends the net claim amount. So the proximate cause, what is the cause of actually catching of the fire, is also assessed. So one account payment may be released for urgent repairs. Known but unreported losses are also recorded as incurred but not reported. So duties of the insured is the all the principles has to be maintained accordingly. The act of utmost good faith, take steps to minimize the losses, and submit a fire report and the loss documents. Now insurer verifies the claims forms and the survey, applies the depreciation and reinstatement value, because they have to calculate what is the actual amount of loss based on which they can actually settle the claims, deducts the excess and applies the average clause if under insured. There also can be ex gratia payments which may be made without any legal liability. Claims are processed as per the Insurance Regulatory and Development Authority of India and the Institute of Insurance Surveyors and Loss Assessors regulations. Then after the expiry of a valid 1 year, the fire insurance policy can be renewed. Fire insurance is a short-term policy which is usually valid for 1 year. Policy can be renewed by mutual consent, and renewal requires an approval from the underwriting department. During the renewal, the insurer considers the past claim history, any new or changed risk, appropriate pricing or premium is done, and of course the principle of utmost good faith applies again at this stage of renewal also. So this is all for this unit. The next unit, we will learn about another specialized insurance product, which is agricultural insurance. Thank you.